Hey guys, this is episode number 35, I believe, of Daily Thoughts with David. Back in the truck again, and we're going to be doing quite a few videos today because I have some time here after work in order to talk about a couple things with you guys that I know you're really interested in hearing about. We had a fantastic week last week for the channel. Doubled, almost tripled our subscribers and our views. So if you guys would, if you're new to the channel, go ahead, subscribe, and go watch some other videos after this one. Today we're going to talk about Credit Suisse and the UBS banking fiasco meltdown that's going on right now. Today is March 20th, which is a Monday. We came back, last week was an absolute fiasco when it came to the fallout from Silicon Valley Bank and Signature Bank, who are two of the largest, at least top 20 banks in the country, who went belly up last week and were provided liquidity from the federal government at the expense of the taxpayer. And they are the first of many to go. Now, Credit Suisse is a Swiss bank, and the Swiss are known for being very good bankers. But they're having a similar problem to Silicon Valley Bank and Signature Bank, where they do not have enough liquidity. And this, to be fair with you guys, Credit Suisse has been on the verge for quite a while now. This is not a new problem. We've heard about Credit Suisse's problems for months, if not years at this point, since, I don't even know, I don't want to speculate, 2021 probably, late 2021, about Credit Suisse having liquidity problems. Things are finally starting to come to head, and this is, I looked up some of the assets that Credit Suisse has and what we're looking at here. We're talking about the number 2 bank in all of Europe. So we're talking about a massive, massive, massive bank in Europe that contains a lot of assets for a lot of different people all across continental Europe and Scandinavia and beyond. Credit Suisse today, I believe their stock went down 50 or 60%. I think it closed down at like 59% below where it was before. Liquidity concerns are all over the place. And there was a talk over the weekend about the Swiss National Bank possibly floating them about $100 billion in order to keep them afloat and keep depositors insured if they were going to withdraw their funds. Now, I don't think that deal went through, but UBS, another large bank in Europe, has come through and decided to buy Credit Suisse for the very, very cheap price of $3.3 billion. And keep in mind, Credit Suisse was, this is at, I believe, the stock value of that is about like 72 cents per share. And I think Credit Suisse was valued at $3 or $4 or something like that a couple days ago. So these guys, UBS, is getting a massive discount on one of their biggest competitors in order to buy them out. And I believe the Swiss National Bank is going to be providing liquidity backstop for that whole deal. So the Swiss National Bank, and I'm sure that the European Central Bank will also be in on that deal in order to provide liquidity, in order to keep this, liquidity friction, from causing too much of a problem and really ruining a lot of depositors' day. The European Central Bank, the Fed, which is in our national bank, our Fed, along with the Bank of Japan, I'm trying to think of any other serious banks we really need to consider. Those are probably the biggest ones. Came out with a announcement yesterday that there would be, it's basically a liquidity program in order to kind of oil the gears, grease the gears of the banking market and the credit market, which is pumping printed money out of thin air into the market in order to provide banks with enough liquidity to cover deposits. I think the population, and this means the world population, well, let's just say the Western world's population. I don't know much about the Asian markets right now, but I think they're also having some troubles. But the Western world is having some serious bank liquidity problems at the moment. And these banks, and this also includes Japan, because Japan is basically part of the West. They're just way out there. But they're providing some liquidity for these banks in order to prevent basically a financial crisis where the banks all fail at the same time and the depositors are basically screwed, and nobody gets their money out, and they have to go through a whole bunch of legal processes in order to fulfill the assets of the investors, of the depositors, of anybody else who's involved in their creditors. And so what we're seeing here is a very, very coordinated effort from all of these central banks in order to provide liquidity for the market. Of course, we need to talk about the fact that this is money that is being printed out of thin air, that is being manufactured on a computer somewhere at the Fed and at the European Central Bank and the Bank of England and the Bank of Japan and all these places. They're just printing money, which, as we know, leads to inflation. And we are getting into this spiral now where we are starting to see the eventual consequences of the response to COVID-19. We pumped trillions of dollars into our own economy, as did all other governments around the world, in order to provide people with enough liquidity to get through this pandemic, because we shut down the entire world. And I'm not going to get into that on YouTube because YouTube will censor me. But regardless of my opinion on that, we shut down the entire world and provided liquidity out of thin air by these central banks in order to grease the gears and keep us going through this really hard time. The problem with that is that $1 trillion+ whatever, I think it was $2-3 trillion in COVID aid. It may have been 4 at this point. Who cares? Or who's counting? That those trillions of dollars, when they enter the market, are not backed by anything. And people have continued to spend. Obviously in 2023 things are slowing down and people are not spending as much. But during 2020, 2021, and 2022, people were continuing to push through what was essentially a hidden recession that the central banks disguised or put off for a couple more years by adding liquidity to the market and continuing to have the economy run at a very, very hot rate when it really needed to cool down and kind of take a breather. And so what we've done is we created inflation that's out of control and is continuing to be out of control. And we've also created a banking crisis now across the world, where the rates in order for banks to make money are so ridiculous that the assets that they had purchased earlier in the pandemic are no longer worth what they were, and they are having to sell a lot of these assets at 80 cents, 75 cents on the dollar, and take massive billion-dollar losses on these in order to cover depositors who are terrified of not being able to get anything out of these banks because everything is falling apart. So we have ourselves a good old-fashioned giant mess, and this is not exactly like 2008, because in 2008 we had a housing problem where people were lending money, banks were lending money to people who could not pay back the loans if things went poorly, and basically we had free money in the market that that wasn't backed by anything. Now we have an entire world economy that is propped up on fake money, that is now experiencing ridiculous it's not hyperinflation yet, but ridiculous inflation, because we pumped all this money into the market that had no backing to it. And now that our economy is starting to slow down because of all these interest rates, all of this extra backstop of liquidity is being sucked out of the market, sucked out of the banks, and we don't have enough money around to fulfill those deposits. So that is the situation we're in right now. Credit Suisse is feeling it. Silicon Valley Bank is feeling it. I believe it's called First Republic Bank. It was another bank that went under today. And their stock was down some ridiculous 40, 30, 50, what, it doesn't matter. They're going under as well. And I saw a report the other day saying that there was approximately 160 other banks in the United States of America that are regional or community banks that are in the same boat when it comes to liquidity concerns and over leveraging of not very good assets that are not worth jack what anymore. So I am waiting for the FOMC meeting, and it's the Fed meeting that's going to happen tomorrow, the 21st and the 22nd of March, to see what they do. But we're going to cover that on another video and talk about that whole deal and what the repercussions of that. But it's not looking great. Let's just say that. So I'll keep you guys updated. I appreciate you watching. Make sure you follow my social media. They are below. I have a Rumble channel where I talk a little bit more about things I can't talk about on YouTube. I have a Twitter, which is Colma63ETH. I have an Instagram that's growing like a weed. That's David Coleman YT. And if you're watching on YouTube, it's David Coleman. So thank you so much. Subscribe, like the video, watch some more of the videos on the channel, and we will see you on the next one. Thanks.